Now, of course, I can't speak for everyone, but one of my biggest reasons for starting my dividend growth investing journey is to get to the point to where I'm earning enough in dividends on a consistent basis to have enough cash flow coming in to cover my bills, and of course, maybe even a little bit more left over after that. Now, at this point, money and work no longer hold the same meaning, as I would consider the situation to be truthfully financially free. But can you retire just off of one straightforward dividend growth ETF and get to the point to where you can live off the dividend income forever? Now, the answer to this is yes. And in this video, we're going to go through exactly how any everyday dividend growth investor with just $50,000 invested into an incredibly powerful dividend growth ETF can achieve exactly this and more. Now, if this interests you at all, make sure to please drop a like down below and let's get right into it. Now, just a side note here, you can use different stocks, ETFs, real estate, different investment vehicles to all get to the same point. The point we're talking about here is to become financially free, once again to the point to where you're earning enough passive income to cover all of your bills and more. But for this video's example, we are going to be using the Schwab US Dividend Equity ETF, or SCHD, as the example for the investment vehicle. Now, one of the reasons on why we're going to be using SCHD is because it happens to be my favorite dividend growth ETF for multiple reasons. Now, the reasons being for the most part is the fact that SCHD has a very cheap expense ratio, which is going to help later on down the line, especially as you acquire more and more shares. Also, the SCHD ETF has a very straightforward and high quality objective, which is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index, which is an index full of high quality stocks that all pay dividends and have a long track record of doing so. Also important to note, SCHD has had some massive growth historically. Over the last 12 or so years, this ETF is up, say, 168+%, and this is not even including the nice starting dividend. And speaking of dividend, SCHD does offer a nice healthy starting dividend yield of around 3.73%, which is really going to help investors reach that point of financial freedom, considering 3 or 4% starting dividend yield is going to generate a decent amount of cash flow, even for the investors out there that might not even have all that much cash balance to start. Now, lastly, I know there's a lot to go through here, but the last reason on why I would choose the SCHD ETF and why I'm actually choosing to invest the majority of my cash balance on a daily, weekly, monthly basis right now into this dividend growth ETF, not saying that you have to, of course, just telling you why, is because this ETF has a history of paying more and more in dividends over time. And with this, we're talking about a healthy dividend growth rate. Now, for those that might not be all that familiar, dividend growth is basically how much in dividends an ETF or a stock pays year over year. And in the case of SCHD, just for a few examples, you can see that in 2021, the ETF paid $2.56 per share. The year before that, the ETF only paid $2.25 per share. The year before that, $2.03 per share. Back in 2018, $1.72 per share. And back in 2017, $1.44. So just from 2017 all the way till 2021, just 4 years, the annual dividend amount that was paid to shareholders for every single share of SCHD that they own is $1.44 per share, all the way up to $2.56 per share, which is quite the increase. And zooming out a little bit, looking at the max time frame, seeing every single dividend that the Schwab US Dividend Equity ETF has paid since the inception of the ETF, you can see that for the most part, year after year, they've been paying more and more and more in dividends, which is going to be key, especially with this video's example of retiring and becoming financially free sometime down the line with just $50,000 invested into this ETF. Now, just a side note here, there are of course other ETFs that are super high quality. Take a look at the VU, the Vanguard S&P 500 ETF, and look at the dividend growth for VU. VU has also been paying more and more in dividends pretty consistently since the inception of the ETF. So once again, I reiterate, for this video's example, we're using SCHD, but there's tons of high quality dividend growth ETFs across the market that also offer a ton of potential for dividend growth investors like you and I. So now it's time to get into the good part. You saw the title of this video. I said that just $50,000 invested into a high quality dividend growth ETF like the one in this video's example, SCHD, could actually allow an everyday investor to reach retirement and to become financially free, potentially even earlier than some of you might think. Now, for this dividend calculator example, and keep in mind, these numbers can change and these numbers are only to be estimated just to give us an idea of what things can look like. Especially for newer investors out there, I definitely implore all of you to mess around with some of these different dividend calculators, type in some different scenarios, and set some goals for yourself, get some motivation. It's really helped me in the past. But lastly, for this example, we're talking about SCHD, which has an initial starting dividend yield of around 3.8 or so percent. But just to estimate it out, we're going to go with 4% right here with the initial annual dividend yield. Then with the expected annual dividend amount increase, we looked through SCHD's dividend growth historically a minute ago, and we saw that some years were around 6%, some years were up to 15%. So we're just going to go with an expected annual dividend amount increase percentage as 8%. Expected annual share price appreciation or ETF price appreciation at 3%. We're using a $50,000 starting budget, which again might be a lot to some investors, or some investors might think that's not all that much to start off with. Of course, this is all going to depend on your own situation. So I repeat, take some time and mess around with some of these dividend calculators and really work things out so you can see what your future can look like. Now with distribution frequency, since the Schwab US Dividend Equity ETF does pay out quarterly, we're going to be using quarterly drip turn down, which means that all the dividends along the way until retirement are going to be reinvested into buying more shares of SCHD, which is really going to turn on the compounding effect and really going to build that snowball bigger and bigger from day one. Now the annual contribution, I did $1,200 on top of the $50,000. Of course, you could do this as zero. You could of course add more. It's only going to speed up the process if you add more money into your portfolio, most likely. But that being said, let's see how long it takes to reach retirement. So the numbers are in for the first year with $50,000 invested into SCHD with around a 4% starting dividend yield, more or less. We're looking at around $2,000 in dividends for the first year, which we sort of touched on this earlier. The fact that the Schwab US Dividend Equity ETF does pay out around a 4% starting yield with the amount of growth potential and dividend growth the ETF has offered historically. For those reasons, just to name a few, are some of the reasons on why I really favor this ETF. For me personally, I wouldn't consider myself a growth investor. I wouldn't consider myself a fully income investor. I would say I'm sort of a hybrid, but the fact that SCHD does have sort of that hybrid approach is what makes me so interested in the ETF. Now, although by year number 2, we're already up to $54,000 in principal after the reinvestment of dividends and after the $1,200 annual contribution, we are only earning $2,300 per year in dividends, which is nowhere near what someone could use for retirement. So skipping down a little bit, by year number 10, this portfolio would already be past $108,000 and around $6,800 per year in dividends, which now we're getting somewhere. But say a 20-year-old or a 25-year-old started investing with around $50,000, this would already be some pretty good performance considering it hasn't even been all that long. Now, by year number 17, this portfolio would now be above $211,000 with almost $19,000 in annual dividends, which is not all that bad at all. Now, from year number 20 to 30, for example, we are not only going to really start to see the principal move up in price, we're also going to see the dividend income really drastically compound here. Now, this is because, of course, the longer you stay invested, the more the initial portfolio will have time to compound, and the portfolio truly will have a life of its own. So by year number 20, once again, if a 20-something-year-old started investing with the numbers we started with, by age 40 or so, this investor would have around $292,000 in principal and almost $30,000 per year in dividends. Now, I'm sure a lot of you guys are thinking to yourselves, well, $30,000 might not be able to cover my expenses. And of course, that's a good point. This is why investing is such an individual process. But for some investors out there, they might only have $30,000 or $35,000 per year in bills, which means 20 years in and $50,000 invested originally, they would be basically financially free. But moving down a little bit further, by 25 years in, with just $50,000 invested and $1,200 more per year, this investor would have around $537,000 and $70,000 plus in annual dividends. Year number 26, $614,000 and $84,000 per year in dividends. And by year number 27, this investor would have over $700,000 invested and over $101K in dividends. Now from year number 27 and on, the numbers just get really, really big. And you can see right here in the compounding chart that things really start to curve up. And of course, a quote unquote large amount of money is only relative to whatever you think is a large amount of money. I would say that with a relatively small amount of money invested into a high quality dividend growth ETF like SCHD or of course others would, in my personal opinion, be able to generate a ton of cash flow, enough for most people to live off of just after say 20 or 30 years. Now, once again, we touched on it a little bit earlier, but the annual contribution amount is really going to change things for the better or worse if an investor is, of course, able to add more into the portfolio on a yearly basis over the long term. For example, if we were to add a zero and add the contribution per year to $12,000. So moving it from $1,200 to $12,000 per year, I get it, that's a huge increase, but just to give you an idea of how much things will change. By just year number 20 at this point, this investor would have $800,000 invested in $81,000 per year in dividends. By year number 25, $1.5 million and almost $200,000 per year in dividends. And by year number 30, $3.2 million and $535,000 in dividends. So as you can see, the math pretty much works out that way. The more that you can add to the portfolio on an ongoing basis, the better the numbers are going to look long term, especially if you have drip turned on. You reinvest all those dividends and just keep your head down and stay investing for the long term. But now I want to hear from you guys down below. For the dividend growth investors out there that are trying to build a massive snowball of a portfolio, what is your largest position you're buying as of right now? Drop it in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.